India is a market where we have a structurally bullish view on. So if there is any significant pullback in the Indian Nifty, for example, we'll be keen to use that opportunity to average in, because I think there's a few good structural drivers going on for India. For example, the reforms that the country has undertaken to make the countries more attractive to, say, manufacturers to house their sourcing activity over here. Also, the fact that the rupee is a lot more stable as well compared to in the past. And I think above all, if you think about it, the ongoing geopolitical tension between China and largely the Western part of the world also meant that other markets, for example, India, will stand to benefit as companies think about making their supply chain more resilient by relocating some of their existing manufacturing facilities, say from China to India. So India is one area that we like. Obviously, the valuation has always been quite high. And I think in the near term, the spike in food inflation is probably also a concern. But having said that, it is one market that will be happy to average in on it. So that's for India. And then for China, I think we have a rather lukewarm view, if you think about it, because I think there is a few things which are, if we look at the key pillars of growth in China, there's property, there's export, and of course, there's a domestic consumption, which are key drivers to Chinese growth. And two out of the three pillars are quite weak, I would say. As we all know, the property market prices has been falling, and the confidence of homeowners or home buyers are very, very low after a recent spate of, say, defaults by property developers. So that in itself is likely not going to be a strong sort of a driver for growth in the next 6 to 12 months. If you look at exports, again, the trade tension with developed markets, namely the US, also will weigh on exports as well. So even though we have seen significant some decline in the yuan renminbi, has not really translated to robust export growth, which historically, say back in 2000s, has been a very, very strong growth driver. And if you look at domestic consumption, that has been the one holding up China's growth. But again, it's a bit more lukewarm than expected. Also because I think people are a bit more adverse at the moment, given home prices are falling and they just came out of COVID, and they didn't really get that much of a stimulus check as what consumers have gotten, say, in the West. So net from these three pillar perspective, I think we have a rather benign view when it comes to China. So overall, a neutral allocation.